Hello, everybody. Welcome to today's webinar brought to you by Bursa Malaysia and managed by our company LifeChamp. Our webinar title today is 4 different types of value traps and how to avoid them. My name is Shane Chu. I'm the moderator for this session. Now, we all love bargains, right? Sometimes we chance upon discounted stocks or cheap stocks and really love cheap stocks. But oftentimes, cheap stocks could become cheaper. Okay, we love stocks with low PE. We love stock with low price to book value. We love stocks with high dividend yield. But sometimes they may turn out to be value traps. So in this session, we are going to examine 4 different types of value traps and how do we avoid them. Disclaimer for this session is that whatever we share in this webinar is only for educational purpose. In no way that I give any recommendation for you to buy or sell any listed securities that we mentioned here. If you decide to make any investment decision, you are 100% responsible for all your investment risk. Now, allow me to briefly introduce our speaker today. He is the content producer for kclaw.com, where he has written over 300 articles and served as a regular webinar host and presenter. He's the co-founder of DividendVault, where he transforms newbies into investors who can build dividend portfolios independently via education. He himself is a dividend investor, whereby his dividend yield range between 2 to 12% per year. All right, so he's none other than Mr. Ian Tai. Ian, good to have you back here in our webinar series.
Hello, Shane. Good to have you. Good to see you back hosting. And of course, it's always a pleasure to be on your platform, although you're organizing on behalf of Bursa Malaysia. It's always nice to actually speak at this wonderful platform. And guys, good evening to all of you. And I have actually prepared a lot of materials. So if I may, I will just share with you my screen. And of course, if you have any questions along the way, I would love to address them right after this sharing session. I'm sure Shane will be more than happy to moderate it. Okay, guys, today we're going to talk about value traps. Now, before that, let me just give you a brief introduction of myself as an investor and how I build my own portfolio. So this is a screenshot of my stock portfolio as of 31st May 2024. So I haven't actually do an update on June. So this is actually what I have done for May. So this is actually how it looks like at this point in time, whereby my biggest holdings is, which is this one. It accounts for 15.9% of my entire portfolio. Then subsequently, the second largest will be 13.5%, then 12.2%. So which means to say when it comes to building my portfolio, the first 3 stocks that I hold dearly, they accounted nothing more than 20%, but they are above 10%. And then we have the 4th and 5th stock, which is at 9%, almost 9%. Then we have 7s, and then we have the 5, and so on and so forth. In total, I have about 17 stocks in my portfolio. Size of the portfolio, 6 figures. Not going to review the numbers to you. Dividend income, 5 figures. Okay, so this is actually the construction of my portfolio. Now, today we are going to talk about what is exactly a value trap. Okay, so just now Shane has actually talked a little bit about it, whereby some of us here, especially let's say for myself, beginning to build my portfolio as a value investor, we like a bargain. We like to actually go to the stock market and shop for discounts. We like to actually find a stock where we believe that it is $1, it is worth $1, it is valued at $1, and the stock price, the stock market somehow offers us to buy this wonderful stock at, let's say, 80 cents, 70 cents, 50 cents, and so on and so forth. Now, the question is, are these truly bargains or are these traps? So as investors, I believe one of the homework is to actually know how to differentiate between the two. All right. So this is actually quite important simply because the ones that are real bargains, they are going to compound your wealth. But the ones that are traps, they will actually hinder your progress as you build your own portfolio. So you need to identify which one is real bargains and which one is fake. The fake one is actually called value trap. Okay, in order to understand value trap, I'm going to just dive deep a little bit about the word value, okay? Now, this is the whole essence of value investing. So let me just read it out to you. Value investing, I believe, or I adopt it after I read multiple books and as well as letters by Warren Buffett. So in essence, this is actually what value investing is. It is actually about accumulating shares of good businesses when they are undervalued over the long term. So the keywords here are accumulation, good businesses, undervalued, and long term. 4 of them. Now, let's expound on these 4. So when it comes to value investing, if you take a look at the first word, which is accumulation or accumulating, so the whole idea about accumulating, right, is that we buy with the intention to keep, which means say when we go into the stock market, we buy a stock, we are actually looking at it from the business point of view, and we want to actually be a shareholder, genuinely as a shareholder of a company. So we are buyer, we buy to keep. We are not buying in thinking that, oh, I'm going to buy it today at $1 and when exactly I'm going to cash it out and sell it for $2. That is actually not our game plan. Our game plan is once we buy at $1, we would like to hold on to it for as long as it is profitable, for as long as it takes. And the duration can be a very long time. It's not counted in seconds, not counted in days, weeks, or months. It is actually measured in years. It can be all the way up to eternity lah. So you can say that the stocks that I hold, typically there are some stocks today, they are already well beyond 5 years and I'm still holding on to it. No issues on that. Second, good businesses. So what do you mean by good businesses? Here the context is actually based on the company's earning power. So what I would like to do is that I would like to find businesses that have very strong economic moats, very scalable businesses, and they have delivered consistent growth in sales, profits, and operating cash flow. So if a company or if a stock can actually demonstrate that, then I would say that that is a good business. Next, we talk about undervalue, the third component when it comes to value investing. So undervalue here means cheap. So this is often measured by PE ratio, PB ratio, and dividend yields, and as well as PEG ratio. So as long as the ratios are attractive and reasonable, then you'll consider that as cheap or at least fair. Last but not least, we talk about long term, which is about genuine ownership. Genuine ownership simply means we, once again, buy to keep and not to trade. So this is the essence of value investing. Now, here is where the problem comes in. Value trap often happens when investors focus mostly on the word undervalue. You see, there are 4 components to value investing, which is accumulation, good businesses, undervalue, and long term. But then the thing is, value traps often happen when investors only focus on the third component, which is undervalue. And they somehow kind of like dismiss, ignore, or just lower the weightage down when it comes to the first, second, and fourth component. Okay, so do remember that. Now over here, I'm going to just share with you 4 different types of value traps, how they look like, so that all of us can avoid it. All right. And with that, let's move on to the first value trap that I think, all right, it'll be interesting for you guys to know. All right. So by the way, Any questions along the way, just feel free to type in the Q&A box. Okay. Now let's continue. The first of these value traps. So now I'm going to go through four. The first one is called anchoring bias. Okay. So what exactly is anchoring bias? Let's take a look. Anchoring bias is actually not so much to do with financials, but it is more towards psychology. So you see, when it comes to investing, it is not so much about making a financial decision. Very much or very often, how we make decisions, right, is actually based on our psychological state. Okay. So which means to say, as an investor, one of the most important homework that I believe that we must do is to actually control our emotions. So having stable emotion, being able to control our emotions is actually very important when it comes to building portfolios. Now let's take a look at anchoring bias. So anchoring bias is about making decisions based on the first information received. Let me give you an example. Now, let's put aside stocks and let's talk about property. Now, the thing is that let's say all of us are going on a property buying spree. Let's say all of us are property buyers, okay? And we want to buy ourselves a property. Now, let's say we are looking to buy a condominium unit in Mont Kiara. Oh, okay. So we are hunting for a property condominium unit in Mont Kiara. And now the thing is that you go on a property, or we go on a property tour with a property negotiator or an agent. So you tell the agent, I want to buy a piece of property, a condominium in Mont Kiara. The agent say, yes, let me take you on a tour. And the first property that you buy, the first property that the agent or the negotiator take you is to tour around a property that is priced at $1 million. Okay. So it's a condominium unit, Mont Kiara, 1 million. That's the price tag. Okay. And it's a nice looking property. Everything seems to be nice. The bathroom is nice, living room nice, kitchen nice, everything nice. Price tag 1 million. And then you think that, $1 million, it's a little bit pricey. So therefore, your property negotiator or agent take you to the next property, which is property 2. So property 2 right now is also located in Mont Kiara. It is also quite decently looking. It is also quite nice, the property, but now the price tag is 800,000. So the question is, guys, type in the chat box. How many of you here think that property 2 is cheaper than property 1? Type in the chat box, say yes if you believe that property 2 is cheaper than property 1. Let's see your response. So Bentley says yes. Okay. Cool One says yes. All right. Chia says no. So Alicia says no. Nick Pang, yes. Muhammad Hafiz, yes. All right. Lisa Ibrahim, not necessary. Richie Isaac may not. Jasvi says yes. Abi says yes. Muhammad Akimi says yes. So a lot of people says yes, but there are some other people who says let's check the size first. Zulkifli says let's evaluate other factors first. Lim Chun Kiat says what about the size comparison and the features? Okay, and there are many people saying no, not necessarily cheap. Okay, need to consider other factors. So as you can see now in the midst of our audience, there are some people say, hey, wait, maybe we should consider other factors first. Maybe there is a reason why property 2 is priced at 800,000 and property 1 is priced at 1 million. There could be other factors. Let's check it out first. However, there are some of you who just say, oh, you know what? First property I see, 1 million. Second property I see, 800,000. What happened? If you are one of those people who say, yes, oh, 800,000 seems to be cheap, and that is simply because the second property is priced 200,000 lesser than 1 million. If you are just basing on this alone, then that is actually an example of anchoring bias, which means to say you are making the judgment on property 2 based on the price, and you base it also on the price on the first information given, which is property 1 at 1 million. So if you are following if you are getting the idea of what anchoring bias is, type in the chat box, type in 1. Let me know whether you guys are getting it or not. All right, so type in 1 if you get the idea of what anchors. All right, so a lot of you guys are typing in 1, which is very good. So there could be, so which means to say most of you guys are actually getting it. All right, and many of you, I'm very happy to find out that you guys are smarter than that. You guys are aware of this. So now let's translate this into the stock market. Let's see how it works. So now we have this is really a Berhad. It is a public listed company. And I got this stock price chart over here. So as you can see, based on the stock price alone, it has actually steadily increased over here. And then it skyrocketed all the way to $20. So now you are here, $20. This is the first information. Stock price go up and it peaked at $20. Then after that, from $20, it drops to 15, then it drops to 10, and now the stock price is 5 as compared to the peak price of 20. So the question is this a 75% discount? So if you believe that, hey, this company, which is a Berhad, public listed company on Bursa Malaysia, is now $5, 5 ringgit, and is 75% below its peak price of 20. If you believe that this is a discount, type in, yes, it is a discount. If you don't believe that this is a discount, type in no. Let me see your response. All right. So Mary says no, Eugene no. All right. So a lot of people are starting to get the idea no. Okay, okay. Fantastic. No, 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 no. All right. A lot of no. Okay. So thank you so much for your response. Now the whole idea is that, you see, without this webinar, right? Without this webinar session, okay? And let's say you are now just alone. Do a little bit of study here, do a little bit of research there. And then you find out that, hey, a certain company like this is now $5. It used to be 20. How many of you can see that because of anchoring bias, right? Because of this factor, right? People think that this can be a discount. If you think that this is actually a possibility, just type in AB. AB stands for anchoring bias. Type in. All right, so Richie says yes, AB, AB. A lot of you guys are looking at AB, correct? Right, fantastic. Thank you so much. Now, all right. So let me just get this once and for all. The key thing here is that when it comes to investing, when it comes to building portfolio, these things can happen. And the trick to avoiding this is that we never look at Google Finance, Yahoo Finance, or whatever stock price chart that you may subscribe to based on price. Don't focus too much on the price. The price is just the price, okay? what is needed is to do a little bit of study about the company's background, the financial reports and all this, and do proper valuation on it. So let's say let's say this is the same company, but now the thing is that we do some valuation. We do a bit of PE ratio calculation for this stock. Now the question is, now here, when it comes to this company, here's the thing. For this company, when it peak, which is over here, $20, the PE ratio, which is based on 2019, all right, figures, the PE ratio is 155. So which means whoever buys here are buying this stock at a PE ratio of 155. From here, it dropped 75% to 5 ringgit. At 5 ringgit, the PE ratio based on the normalized earnings, it is at 39. So the question is, how many of you believe that PE ratio of 39, how many of you would like to buy a stock at a PE ratio of 39? How many can accept? If you can accept, just type in accept. If you cannot accept, 39 PE ratio is too high. Just type in no. Let me see the response from you guys. All right. So a lot of you guys says no. All right. No, 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 no. Fantastic. So because of this, if you are an investor and if you calculate the PE ratio, all right, the thing is that this kind of thing, right, can be easily avoided. It's kindergarten, all right? Once you have an awareness of anchoring bias, once you know that you should be doing your valuation, you should be calculating the PE ratio and all this kind of stuff, it is very easy to avoid this kind of mistake, all right? Mistakes like how people actually buy a glove stock, or this is actually a glove stock, by the way. Actually, some of you guys already got it correctly. So you don't need to buy one of this stock at this kind of price. It doesn't make a lot of sense, all right? So once you have an awareness of all this knowledge, then this kind of mistake will not happen. So imagine if you buy it at $5, it goes down, all right, to somewhere between $1 to $2. Maybe here it seems to be about $2 or $3 over here. So if you buy here at 5, now you're still having a capital loss over here, simply because you have purchased a company like this at the PE ratio of 39, which is quite high, right? So you can actually avoid this if you're aware of this value trap. So now, here are some key lesson points when it comes to anchoring bias. Number one, never look at the stock price. Always do valuation, okay? Never decide on the stock based on the first information. Wow, somebody tell you that the stock used to be this price, now it is at certain price. Don't fall for that. Number two, don't make decisions based on price. Always use valuation ratios. And the final lesson point for anchoring bias is this. Whenever you encounter a company that you think that it is actually quite familiar, you're quite familiar with this company and the price keep on falling, it doesn't mean that the stock is undervalued. So the moral of the story is don't look at price, okay? That is actually the trick to deal with anchoring bias. Next, let's look at value trap number 2. So we are going to spend a little bit more time here, value trap number 2, because a lot of people tend to fall for this trap, okay? Which is the trap of low PE ratio. It's not to say that as an investor, I don't invest in stocks that are of low PE ratio. But the thing is that you need to identify which of these stocks, when it comes to low PE ratio, it's a real bargain. Which of these stocks, when it comes to low PE ratio, it's a fake one, right? It's a value trap. So you need to identify. Now, I'm going to just share with you 3 scenarios of how this can be a value trap. Let's take a look. Situation 1. Now, let's say we look at the stock. And the first thing that we look at is this. Okay, we study the company's financials, and we know that this company at year 1, it has earned 100 million ringgit. And based on 100 million shares, its earnings per share is 1 ringgit. The stock price at year 1 is 20. So 20 divided by 1, you get a PE ratio of 20. Okay. Then the following year, year 2, the company has made some growth in terms of earnings. Its earnings grew from 100 million to 110 million. Earnings per share increased to $1 or 1 ringgit and 10 cents. Stock price has increased to 27 ringgit and 50 cents. So if we take 27 ringgit and 50 cents divided by $1 and 10 cents, your PE ratio is 25. Now, here is the next situation. Now, here is the real situation. Pay attention, huh? Okay. From here to here, normal. From here to here, here's the case. Okay. Now we are at year 3. At year 3, the company not only make some money from its business operation, this is highlighted in blue, but in addition to its profits from its business operation, it also had made a one-off disposal gain on some of its business. Maybe it disposed some subsidiaries, and as a result, it has recorded another 130 million in earnings. This plus this, it has reported 250 million in earnings. Earnings per share is $2.50, and right now the stock price is 36. So if we take 36 and divide by $2.50, your PE ratio is now 14.4. So 14.4 is lower than 25, it's lower than 20. So now, the question is this company undervalued? Type in the chat box if you think that PE ratio of 14.4 is undervalued. If you think so, type in yes. If you don't believe that this is undervalued, type in no. Let me know. Okay, so there is one who says yes. Okay, so there's another one who says yes. Okay, most people says no. Okay, so which means the same majority of you guys says no. All right. Only just 2 of you guys says yes. Okay, so for the benefit of everybody, let me just explain. So the answer is actually correct with the majority, which is no. All right. That's not how you use your PE ratio. And how people fall into this trap is that they don't read financial reports, they use screeners. All right. So they use screeners whereby they just screeners, they are machines, right? They just take the stock price and take the latest earnings per share, and then boom, they say the PE ratio of a certain stock is 14.4. And then they think, oh, I never seen this before. How come this stock, the PE ratio used to be above 20, now the PE ratio is 14.4? It doesn't, wow, this seems to be a bargain. Not quite, huh? So most of you are getting it correct. And if you know, some of you guys put in the comment, which I very like it, which is Lim Chun Kiat says, you have to look at the core profit. Exactly. All right. When it comes to using PE ratio, you must look at the stock's actual ability to earn money. So in this case, what should investors do? Investors should take this 250 million. You minus off this one-off disposal gain. So the core profit that you should be getting is about 120 million. Your earnings per share, if let's say the company continues to maintain its numbers of shares at 100 million, your earnings per share should be $1.20. Then you take stock price of 36, divide with $1.20. That is how you get your true PE ratio. From there only we decide whether the stock is really a bargain or not quite a bargain. That's how you do it. Okay. So that is situation one. All right. Good job, guys. You guys are actually doing it. Most of you guys are getting it really, really well. It's time for us to look at situation two. Let's get into it. Now, we are at year X. The stock is making 50 million ringgit in earnings. That's the latest earnings. So based on 100 million shares, the earnings per share is 50 cents. The stock price for this stock is 4 ringgit and 50 cents, and the PE ratio is 9. Okay, that's it. I'm going to just pause it here. How many of you think that PE ratio of 9 is not too bad? All right, and you think that this automatically is undervalued? Type in yes if you think that PE ratio of 9 is automatically undervalued. How many of you think that I should look further? Right? So a lot of you guys says, so some of you guys says yes. All right. Cool one says look further. Okay. So we have a mixture. Huh? So some says yes, yes, yes. Some says look further. Okay. As an investor, we should always look further. We don't actually look at the latest earnings and decide straight away. That's not how we do it. We should pass. After we look at this stock over here, 1 year before, 2 years before, 3 years before, 4 years before. So this is how the earnings look like. 4 years before, this stock made 180 million in earnings. 3 years before, 150. 2 years before, 100 million. 1 year before, 70 million. The latest year, 50 million. So as you can see, the earnings of this company has been declining over time. So now my question is, how many of you still think that this PE ratio of 9 is still undervalued? How many of you believe that this PE ratio of 9 is meaningful and undervalued? Type in the chat box. Yes, if you believe. No, if you don't believe anymore. Just type in it. Just type in. All right. Correct. So most of you are getting it right. So this is situation number 2. Situation number 2 is actually this. As an investor, we don't just look at the latest earnings. We backtrack it because it's a track record of the company. And if we find that the company's performance is looking something like this. All right. Once upon a time, it used to. Now, if the fundamentals over here will be deemed to be weakened over time. This kind of thing, all right, is an indication that the fundamentals is getting weaker. So if the fundamentals of the company is getting weaker, valuation ratio like PE ratio is no longer meaningful. So that is situation number 2. Okay. So situation number 2 is a value trap simply because a lot of people are not aware of this, and then they just say PE ratio 9 cheap, buy. They forgot that they need to account for what happened in the past. So that's a value trap. Now, let's look at situation number 3. Situation number 3 looks something like this. Okay. So now we have a company where if you look at this annual report, you can see that the earnings have been increasing consistently over the long term, up from 100 million to 110 million, 125 million, 145 million, 170. So the earnings per share has been increasing over time. Now, here's the thing. If you take a look at the company's operating cash flow, which is OCF over here, what we can see is that over here, 4 years before the latest, the company has brought in 30 million in positive operating cash flow. The year after, negative 30, which means cash is flowing out, 30 million. Then the year before again, 40 million cash out. Then the year after that, 60 million cash out. Then also the latest year, cash out 60 million. How many of you have seen this kind of company before, where the company has been consistently delivering increasing amount of earnings, but yet every single year, don't know for some reason, the company's operating cash flow keeps on flowing out of the company, never in, always out. How many of you know that got this kind of company? So some of you say, it reminds you of certain company. Lim Chun Kiat says fraud. So there are certain companies like that. So what do you do with these kind of companies? All right, consistent growth in earnings, cash outflow, cash keep on flying out on. So when it comes to this company, usually I don't touch, okay? So when it comes to this company, there's no point in using PE ratio anymore. There's no point in taking the stock price and say, oh, the stock price is, let's say, X, and then we divide it by earnings per share, 1 ringgit and 70 cents. You get the PE ratio, and then you decide whether it's undervalued or overvalued. For this kind of stock, no need to do that. No point already. Simply because as an investor, earnings, very good ability to generate over the long term. So earnings is great, but it has to be backed up by solid operating cash flow. So if the company has no operating cash flow, forget it. Just call it a day. Find another company, okay? So therefore, this is how we use PE ratio. There are 3 things, or I should say 2 things that we need to look at. Number 1, exclude all one-off abnormal gains and losses. Okay? Anything that is not so business operational, all right? We have to exclude those kind of gains when it comes to calculating PE ratio. That's 1. Number 2, a stock, all right? When it comes to earnings, the earnings here, what we need to do is that we need to find out the actual ability of the company when it comes to earning recurring and increasing profits. So which means to say, if you find out that the company is making 100 million ringgit in the latest financial report, so the question to ask is that, can the company continue to make 100 million or more in the future? All right, so that is actually what we are thinking. So we are not looking, so that's why we, once again, going back to the first one, if this 100 million ringgit is inclusive of one-off gains, that's why we remove it. And last but not least, after 1 and 2, the third one is that you have to actually look at operating cash flow. Make sure that the company, as long as it's continuously growing its earnings, its operating cash flow should be positive, and continues to grow. If it fulfills all these factors, then only we can use PE ratio. All right. So with that, we have covered the second value trap, which is low PE ratio. Now, next we are going to look at low PB ratio. Okay, let's take a look at the third one, low PB ratio. So here is another situation. This is actually quite this is quite for people who are looking at net strategy or something, or they are just focusing so let's take a look at the company's balance sheet. We have assets, and then we have debt and equity. So this is the assets of the company. We have property and equipment, we have inventories, and then we have cash. All this add up 1 billion ringgit. So we have 1 billion ringgit, and this 1 billion ringgit is funded by debt 100 million, equity 900 million. So which means to say, if you sell off everything, you sell off the property, you sell off the equipment, you sell off all the inventories, you can't sell off cash. All right, so you already got the cash. Assuming that you sell off everything and you somehow get $1 billion. Okay, you take the $1 billion, you clear off 100 million in debt, you'll be left with an equity of 900 million. Okay, now the thing is that this company has 1 billion shares in issue. So if you take 900 million, you split it up with 1 billion shares, you should get a book value of 90 cents, 45 cents. All right. So if you take 45 cents with times 1 billion shares, your market cap would be 450 million. Now, so therefore, if you calculate the PB ratio, all right, where you take the price, which is 45 cents, divide by 90 cents, you should get a PB ratio of 0.5, which means you got the opportunity to buy the stock right now, all right, at 45 cents. And if the company chooses to liquidate tomorrow, you somehow may get a chance to actually get back 90 cents. Every 45 cents you put in, you might actually get 90 cents. How many of you are following? All right. So the thing is that how many of you use this strategy when it comes to finding cheap companies? Type in the chat box if you are one of those people who use PB. Type in PB. If you are one of those people who don't use PB ratio, just type in no PB. Let me take a look. Okay, so Jason Wong says no PB. All right, so Eugene Wong says, Charlie Munger said before, it's not that much fun to buy a business where you really hope this sucker liquidates before it goes broke. Yeah, true also. So a lot of people says no. All right. Ang says yes for banks only. Phil says sometimes many people say no. I don't use this PB ratio quite a lot, to be honest. I use a lot of PE, but not PB. All right. So when it comes to of investing, I don't buy it lah. All right, let's put it that way. I don't really buy a stock or think that a stock, I don't buy into that. Okay. So here is the thing. For me as a person, as an investor, my take is that when I buy into a stock, I'm buying into a business. When I buy into a business, I look at its value. So looking at this company, where, or I guess that's fixed. Let me just continue. So let's say we are looking at this company, and I know that the earning power of the company whereby the company's earnings increase from 180 million to 150 to 100 million. So it's no longer meaningful. About PB, I'm buying this stock at a PB ratio of 0.5. Who cares? Who cares at this stage? It's not demonstrating consistent earning power. Who cares about its book value? So to me, evaluate this company. This company, in fact, is no longer in my list. So there's no need to actually think about whether or not this company is undervalued or overvalued. We just kind of like throw it in the rubbish bin. Next scenario. This is actually a worse scenario than the first one. A lot of companies where their PB ratio is below 1. It can be 0.5, 0.4, 0.8, whatever. What the ratio is. Many of you would like to buy a stock whereby its PB ratio is below 1, and below 1 means a lot of people think that it's cheap, but then if you look how it looks like, and how many of you are interested in buying this kind of stock? All right.
Ian, I think your internet connectivity has been
Okay,
very
low
poor
PB
for a while. Yeah, I
in
suggest
terms
you turn off
of
your video. Right, I think the speaker has just dropped off the line. Um, let us wait for him to reconnect back. Ian, your
still poor or not?
internet connectivity was very poor just now. I suggest that you turn off your video camera so that it allows a smoother transmission of your slide and voice.
Okay, let me just remove this. How about right now? Is this okay? Is this okay, guys?
Yeah, I can hear your voice.
So Shane, should I continue or
Yeah,
how?
carry on, carry on. I think maybe
Carry
you
on,
should,
huh?
yeah, I think
All
maybe you
right,
should repeat the entire slide, because your audio connectivity has been lagging.
okay. So which part
Can
should
you
I
repeat
start
the
off?
entire point?
For which one? PB? Or I just stop at where exactly should I begin, Shane?
I think for that slide, the last slide,
From here? Or from here?
I think from here.
Okay, so let me just repeat from here. So when it comes to PB, I don't really use it a lot, simply because as an investor, the key thing about investing in a stock is to buy into a business that has demonstrated and will demonstrate consistent earning power. All right. So the earnings is actually more important than the balance sheet. Now, the thing is that some people may buy into a stock simply because the PB ratio is very low. Okay, like 0.5, 0.4, 0.8, whatever the amount is. But to me, what is the point if I find that the earnings of the company looks something like this? What if the company has demonstrated diminishing earnings power, whereby its earnings have actually declined from 180 million to 150 million, 100 million, 70 million, and 50 million? So if you see that the company has been consistently reporting decline in earnings, then what's the point of using PB ratio? All right, so that's my take. Now, another situation, all right, is where it's worse than the first one. Some people may buy into a stock simply because the PB ratio is very low. But if you look at this kind of income statement, the stock is actually making losses for the past 5 years. Now, in this case, what is the point of buying this stock? It doesn't even make money. There's no PE for you to calculate. So why bother about PB? So in this case, there's no longer any meaning in the valuation ratio. Okay? When it comes to determining if this stock is undervalued or overvalued. No point already. And also for this case, all right, once again, doesn't matter whether the PB ratio is 0.5, 0.4, 0.8. If the earnings have been also like this, inconsistent, some years it make, some years it don't make, PB ratio is no longer meaningful, all right? So the thing is that when it comes to PB ratio, right, it's really not my preferred style. It's simply because PB ratio, if one only uses PB ratio to evaluate a stock, it is actually just a strategy, a valuation metric that focuses only on the current balance sheet. And this may work if the company chooses to liquidate, which most likely it will not. And I'm not too interested to find companies that will liquidate lah. All right, to be honest. So this is not my preferred style, as it totally ignores the company's ability to earn recurring income. So when it comes to this value trap, right, it is not so existent for me lah. Simply because I don't think I will fall for this kind of value trap simply because I don't really use PB ratio that much lah. All right. And now, oh, this is very interesting. High dividend yields. Okay. So the thing is that a lot of investors, including myself, will want to actually achieve high dividend yields. All right. So who likes to buy a stock at, let's say, $1 and receive, let's say, 6 cents, 7 cents, 8 cents in dividends per share, whereby you're getting a dividend yield of 6, 7, 8%. Who doesn't like that? Now, this could be one of the key value traps that many dividend investors or many sincere value investors might fall for. Okay, let's take a look. This will be very interesting. Okay, raise up your hand or type in yes. Okay, if let's say you're interested in this kind of stock. Over here, we have the latest year. The dividends per share is 7 cents. Stock price $1. So you're getting a dividend yield of 7%. How many of you will be interested to buy this stock at 7% dividend yield? Oh, Doris is already saying, look further. Okay, type in the chat box. Yes, interested, and look further. If you haven't made your decision, you can put in look further. So a lot of you guys are already saying yes, yes, yes. Okay. Right. So some of you guys are actually looking at look further. All right. Need past record. Very good. Okay, 7% usually not sustainable. Better 3 to 4%. Okay. A lot of people say look further. Fantastic. Now, let's look further. Okay. Now, this is another piece of information that I would like to give it out to you. By looking further, okay, if you look back the past 5 years, every year it pays you 7 cents in dividends per share. Every year, without fail, you will get 7 cents. 7 cents in dividends per share. Now the stock price is $1. Dividend yield 7%. Okay, type in the chat box. Type in the chat if you are already convinced. saying that this stock can buy, can consider buying, type in buy. If you are okay, happy with what you see, type in buy. If you are not happy and still want to look for, type in look further. All right, let me know. So a lot of people say buy, 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 buy already. Okay, okay. Q1 says look further, look further. Chu Channing says look further. Fantastic. Okay lah. So that guys, now what is most are saying buy, but then there are some of you guys who say no, Ian, not enough. All right, I'm gonna compare this. I'm gonna compare this with its past stock price. Okay, so 4 years ago, when it pays out 7 cents in dividends per share, the stock price is $2. If you buy it, if you buy the stock here at $2 and it pays out 7 cents, your dividend yield will be 3.5%. If you buy the stock 3 years ago, the stock price was $1.75. So your dividend yield will be 4%. 2 years before, the stock price was at $1.40. So the dividend yield will be 5%. So after so long, it has continued to drop. Right now, this is the lowest price you can get for the same stock that has been paying consistent dividends for the past 5 years at 7 cents per share. All right. So the thing is that how many of you are already convinced, all right, that you think that, hey, the stock price is actually cheap. It's $1 and the dividend yield is 7%. Okay. So the question is this: how many of you guys are ready to buy already? Type in. So a lot of people say no, 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 no. All right. So a lot of people are still not too happy with the information given yet. Now I'm gonna give you one more information. Okay. The earnings. Okay. All right. This is the full information that I can give you. This is the full information. Let me explain to you. The blue color here, this would be the dividends. 7, as you can see, is a flat line over here, 7 cents per share. But if you look at the company's earnings, the earnings have been decreasing over time. Earnings here, 100 million, dropped to 90 million, dropped to 80 million, 70 million, and 50 million. So if you look at the earnings per share, it has been declining. But somehow, because the company has a lot of cash, it can maintain its dividends per share at 7 cents per share. Okay. Initially, something is weird. Yeah. Okay.
Ian, your connection is breaking again.
Suspicious. All right. Can buy. Trap. Type in trap. Oh, break again. Okay. So let me just let me just repeat myself again. Based on the information given, how many of you say that this is actually can buy? Just type in buy. And how many of you are saying that this is a trap? Then just type in trap. All right. So you didn't say trap. No, Zaharuddin says trap. So loosely trap. Now a lot of people can see the trap already, huh? Okay, fantastic. So guys, this is how not to use dividend yields. Okay, this is how not to use dividend yields. Just now, the whole reason why this case study is done is simply because there are some people who just based on the latest dividend yield, then they decide. This one is level one kind of investor. All right. The type that will fall for this kind of trap. Based on latest dividends per share, stock price can buy already. Cannot. That's level one. Level two is the kind of people who backtrack. Oh, let me see the past record of dividend payout. From there, I can decide already. Cannot. Not yet. That is level two kind of investor. Cannot. Level three is the type that will do relative comparison of dividend yield. So they see what kind of dividend yield that they can actually get in the past and compare it with the present. From there, they can decide already. The answer is not yet. This kind of investor is level three. The final one would be level four. So when it comes to level four, at the very least, they believe that if a company can pay out 7 cents, its earnings should be more than 7 cents so that the dividend payout would be sustainable. So if you are level 4 and you can see this through, then you should be able to avoid such such value traps already. So back to how not to use dividend yields. Okay. Look at this flow over here. This is how some people fall into value trap based on dividend yields. The first one is, step one is they filter stocks with the highest dividend yield using screeners. Okay, so which means they go and use some screeners and then they filter out the stocks with the highest dividend yields. From there, they select the ones with the most consistent dividend payouts. Then they compare the current dividend yield with the past historical. And then from there, they can make decision already. So if your system looks something like this, then you are very prone to value traps. So now, the question is, how do we avoid this kind of value trap? All right. The key thing is to always go back into basics. And over here, the ultimate solution to avoiding value trap is to make sure that you assess the fundamentals of the company first. Okay. Look at the company's economic mode. Look at the company's income statement for the past 10 years. Make sure that it has delivered consistent growth in sales and profits. Check out its cash flow statement, making sure that its operating cash flow has been rising over time. And then we look at its balance sheet just to make sure that it really has the cash to pay out dividends. All right. And also, it has the capacity to service its debt if the company is leveraged, or even better, if the company is not leveraged, doesn't use a lot of debt, very good. This kind of fundamental quality must be there first. If you find such a company, very good, then only you do the valuation. All right. If you can do that, most likely you can avoid almost all the value traps that are in existence in Bursa Malaysia. All right. Almost lah. All right. Give it a 80% or 90% chance of eliminating such risks of hitting value traps. Okay. So if you happen to be one of those people who want to invest for dividends, this is a smarter way to do it. The first step is not to look at high dividend yields. That's the wrong move already. The first step is to look at business model. Then we talk about earnings power. Then only we do valuation, like dividend yields, PE ratio and dividend yield. Then after we have done the business model, the financial strength, and the valuation, then only we consider buying the stock if the company is really, really undervalued. All right. So which means to say, by focusing on good businesses, you can actually avoid a lot of value traps in the stock market. All right. So with that, I have ended my sharing session. So sorry that some of the part that's breaking due to internet connection. And with that, I'll pass back the control to Shane. Shane, all yours.
Thank you so much, Ian. I think during Q&A, you can turn on your video camera, I guess. All right. So if you have any questions to ask our
Yep.
speaker today, please write in the Q&A. Or if there's any part that you want him to clarify again, or because of the poor internet connectivity that you didn't get to understand it better, so you can type in the Q&A, so we'll attempt to readdress the point that went missing just now.
Mhm. All right. There are some questions, right?
Yes. So the first question I see on my screen is, what is considered good debt and what level of debt is considered healthy?
Okay. So the thing is that you can calculate its gearing ratio. So gearing ratio means you can take the amount of debt it has, divide by equity times 100%. So if let's say you find a figure which is below, let's say below 50, let's say at 20%, okay? So usually that is actually quite healthy lah, which means to say the company is actually very much low in debt. But with that say, if let's say you find yourself a company that has quite high in terms of debt, typically what I like to do is that I like to take let's say amount of debt. Let's say if a company has $1 billion in debt, the next thing I will actually look at is actually the company's operating cash flow. All right. So if the company has $1 billion in debt, but the company can make 500 million in operating cash flow, which means say if you choose to, right, it can actually it takes the company 2 years to actually clear off the debt, then I think it's actually quite helpful lah. All right. So I would tend to measure debt with operating cash flow because you need good cash flow to service debt. If a company has a lot of debt, but it struggles to actually generate operating cash flow, it's like someone with debt and he struggle to pay his bills. I mean to say, even banks also lend out money based on our ability to pay off debt, our employment, our business income, and all this kind of stuff, right? So if our ability to get debt is through our income, then I guess it's the same thing with stock.
Thanks, Ian.
So Shane, or yours?
All right. The next question is from Askar. Now, while the webinar focus today is on avoiding value traps, are you able to provide an example of a stock that initially appeared as a value trap, but later turned out to be a good investment? So this can help to illustrate the importance of analysis.
At the back of my mind, I think of a stock lah, but I won't name the stock lah. But it's just funny to see that stock. Okay, because I think these days there are a lot of companies that doesn't. I mean to say that the stock price performance over the short term is crazy lah. All right, it's just funny to think about it lah. Okay, so I won't name any stocks for the time being lah. But in most cases, if the stock actually, if let's say after I have presented quite a number of ways on how people fall into value traps, the way of anchoring buyers, the way of low PE ratio, which means you take the latest earnings per share and forget about the past record, or you kind of like included the one-off gains into calculating your PE ratio, or you kind of like fall into the fall into the trap whereby the company has been, wow, so nice, polishing the earnings figure, but no cash flow one. Usually they end up bad lah. It will not turn out to be a sustainable, good investment. Just avoid that and you should do fine lah.
All right, so the next question is from Y Chong.
Mhm.
For normal investor, we can only analyze companies' performance once every quarter via their quarterly report. So sometimes the company might not be performing well on the second quarter, but the return to good performance after that. So how many quarters of bad quarterly reports would you consider that a company is losing the earnings power and will sell off the company stock?
First, I disagree. So sorry, simply because we can always study the company's performance, not just on a quarter to quarter basis, but on an annual to annual basis for as long as it is listed. All right. So like for example, if you want to access Maybank or Public Bank, you can always get access for free the annual reports and the quarterly reports of these kind of companies for the past 10, 20 years. Not 20 years lah, maybe 10 lah, okay? Maybe 10 plus years lah. You can get it one. All right. So it's not always the latest quarterly report. And to the second part of the question, one bad quarter, it really depends on the context. So the context of the bad earnings, right? You have to take a look. Like for example, let's say Padini. All right, it's a fashion retailer company, boutique, all right, making money out of selling clothes, fashion items. But during MCO, the government shut down all the retailers. Nobody can actually open their shop and do business. So therefore, they have a bad quarter. So in that context, do we penalize Padini for bad performance? You can't, because the context is at that stage, as a retailer, they can't do business. So in that sense, it's not fair. I don't think it's that fair to actually penalize or value the company based on this kind of events lah. All right. So the context is actually very important to know why there is such a bad performance. So Shane?
All right, thanks, Ian, for addressing the question.
Mhm.
The next question is by Jason. How can charts help in evaluating the optimal buying price after your analysis?
You mean technical charts? Actually, I don't look at technical charts. So anything to do with technical analysis, all the stochastics, or the oscillatory, or the volume charts and all this kind of stuff, I don't depend on them. Because again, value investing, right? The intention is not to go in and out of the market. The intention is to accumulate. It's like if let's say today lah, all right, I have 1 million public bank shares lah. Then who cares about the ins and outs of the market already? You probably just sit on your 1 million public bank shares and just enjoy every half a year the dividends that come in lah. All right. So the whole mindset is about accumulation, not so much about trading.
Right, thanks, Ian. So are the growth stock selection criteria similar to dividend stocks? So this is a question by Chen Ning.
Growth and dividend, they are similar in one way. Both of these companies are profitable. Both of these companies, when it comes to operating cash flow, they are positive and growing. The difference lies in how the company chooses to utilize these profits and operating cash flow. So for dividend stocks, profit come in, cash flow come in, they paid out most of them to shareholders. Done. Okay? It's like your Carlsberg and Heineken. Bringing in cash flow, very profitable, but it's not like the government is going to give them another license to build another brewery anytime soon. So because of this, they might as well just pay out whatever they receive to shareholders lah. So in a sense, that's dividend stocks. But for growth stocks, profit come in, cash flow come in, but hey, wait a second. There are some ways I can use to actually maximize the benefit of the company. Like, for example, if the company is very high on debt, pay debt. If the company wants to do share buyback, they do share buyback. If the company wants to do acquisition, I want to buy out my supplier, my distributor, my vendor, my competitor, or I want to invest in another business which is unrelated to my business, I do that acquisition or capex. So now this will depend on the capital allocation strategy of the company. So in terms of growth, that is actually coming into play when it comes to that kind of consideration. So
All right.
Shane?
Thanks, Ian.
Uh-huh.
So the next question is by Bruce Lee.
Mhm.
Can we consider the target price and recommendations from the investment uh, banks analysts to buy and sell and avoid value traps?
You see, when you comes to target prices, what if I actually like the analysts, you see there are different banks, there are different stock brokering houses, they're going to have very different people as their analysts. So we do not know who the analysts are in the first place, right? There could be 20s of them. Now, assuming that there is a stock, let's say stock A, and then we have this analyst, and then they give you the target price, which is $5. So this is your first information, right? $5, ringgit. And then the stock price now is 350. Do you see that as a discount? All right. Or are you making a decision based on influenced by this $5? So in that sense, that is actually value trap number one already, which is anchoring bias. You're making a decision based on price and not just price. It's someone else's target prices. So I would say that in order to avoid value trap number one, anchoring bias, forget about target prices lah from all these analysts. Just do your own calculation of the valuation ratio and just stick to that. I think you will do fine.
All right. The next
Yeah,
question is by Mohammad Rusty. Which is more important? Is it cash flow operations from operating activities or net profit?
both. Look at both. Very important. So yes, of course, profits does not equal to operating cash flow, but you look at profits because that is how you profits will tell you, because a lot of people, I mean, not a lot of people, because stocks, they are valued based on profits. It's like PE ratio. It's a valuation metrics based on earnings. So we look at profits for valuation purposes, and we look at operating cash flow to see whether operating cash flow can back up, is a can be is like back or supported. All right. Can the profits be supported by the operating cash flows? That's number one. And number two, whether you invest for growth or dividends, you must have cash flow first. If you're investing for growth, you must have operating cash flow, positive and growing first. Then we take a look at this capital allocation strategy, where you want to put capex, acquisition, share buyback, debt, dividends. Or if it's a dividend stock, then cash flow is more needed because you need cash to pay dividends. So look at both. Both are equally important.
All right. Thanks, Ian.
Mhm.
So, which matrix is better? Is it price to earnings, PE ratio, or price to sales? But price
E,
to sales like bypass one-off gains, right? So that's the comment by Ben.
look PE lah.
Okay, to you, PE
No
is more
need P,
important, yeah?
no need PC, no need PS.
Yes.
Mm.
All right. The next question is, how do we use PEG ratio in value investing?
So this is actually for growth investor. So the first one is that first the PE is PE ratio. So you got first half of the equation done already because you have PE. Now the thing is growth. So when it comes to growth, this one is a bit tricky. For me personally, what I would do is that I will backtrack it for the past 10 years and calculate the earnings growth rate of the company. So this one, you need to use the CAGR calculator. Then from there, let's say the calculator says that, oh, the growth rate is about 10%. Let's say the PE ratio is 20. The growth rate is 10%. So 20 divided by 10, you will get a PEG ratio of 2. And with that, I will actually take this PEG ratio of 2 and compare it with its peers, just to see how the valuation is when it comes to similar stocks in the similar industry for PEG ratio.
Thanks, Ian.
Yep.
How do we value the company that has healthy cash flow from operating activities? So if the company always have positive operation cash flow for 1 or 2 quarter of every years, is it considered okay? So this is a question by Evelyn. Sorry, has negative cash flow.
For 1 or 2 quarters every year.
Yeah, like
So
yes,
which
that's
means
right. So like
year, 4
every
quarters.
year they have 1 or 2 quarters which incur negative operation cash flow. Is it okay or not?
Very rare leh. I mean to say I've been studying so many stocks very, very rare lah. That will happen. And even so lah, it could be a seasonal thing lah. So it all goes back to the context of the stock, the nature of the business, if it does happen lah. Okay, so you need to actually look at the context behind it. But for now, I would say if let's say the annual says that the annual, which means quarter 1, 2, 3, 4 combined, still positive, still okay. That means to say 3 quarters positive, 1 quarter negative, still okay.
All right. So what is the main difference between forward PE ratio and trailing PE ratio? Which one do you use?
I don't use any. I think trailing means backtrack the latest 12 months, right? Actually,
Yep,
I don't.
that's right.
I use trailing, but I don't use forward lah.
You don't use
So
forward.
I don't use forward.
Why not?
I don't know. So I mean to say, I look at forward. I guess forward simply because it's actually based on what is to come over the next 12 months. That's like that means to say there's some element of projection, right? But if it's trailing, at least I get to see, oh, it is actually actual. Actually, the company has already made 100 million. So I will base on that lah. But if you use forward PE ratio, it's like the company could be making 100 million. What if it doesn't, right? So maybe because of that, I tend to use trading over forward lah, because I like to see something more substantial lah, like something that has been reported in the document, like official document, like the quarterly report and the annual report, then I'll go with that.
All right. Thanks for sharing your perspective, Ian.
Mhm.
So the next question is by Y Chong. Will the debt ratio or P ratio change from time to time? Or is the criteria the same regardless the economic environment?
Yes. I mean to say, not to say, of course it will change, but let's say if for me, I will look at 10 years simply because I also want to look at the culture of the management of the company. So let's say the management, the culture, the character, the behavior of the company is really, really conservative. It doesn't like to use debt. So for the past 10 years, you should see a balance sheet whereby it has very little use of debt. That's the culture. That's what I want to know. Okay, if a company, the debt ratio, maybe on 1 year the gearing ratio is 100%, next year 150, then after that 80, then 200, and all this kind of stuff, then you know that that's the culture of the company lah. And then the company is like, oh, like that one, the company. Then from there, as an investor, I get to choose whether or not I like this company's culture, the one that have very high gearing ratio and all this kind of stuff, or is it the one that is very conservative with that? You can only tell the culture if you look like 5, 10 years from today lah, the annual reports. From the culture, then I decide which one I like, which one I don't like.
All right. The next question is by Eugene. Do you consider or look at earnings yield?
Earnings yield is like PE is like price divided by earnings, right? So earnings yield is just the balik, right? It's like earnings divided by price, right? So usually I don't calculate. If I already calculate PE ratio, then I don't really calculate earnings yield lah, because it's just the same formula inverted only mah. So I don't calculate earnings yield lah. It's actually more or less the same thing. Oh.
So in other words, a P ratio of 10
Mm-hmm.
is equivalent to 10% of earnings yield,
Yeah, you can say that lah. A
right?
PE ratio of 20 is earnings yield is
5%.
5%. Ah,
Yeah. So that's how you can look at it. So the
uh-huh.
next question is by Y Chong. Um, how will you evaluate the growth and the prospect of those newly listed IPO shares? Will you consider them in value investing?
Oh, it depends but I haven't really buy into any IPO yet lah. So so I may look into IPO, but then the thing is that I haven't come across something that I like yet lah. Or something that I believe that now there are existing shares, existing stocks in the stock market versus IPO, right? I still like the one that is in existence lah, as compared to IPO. That's for now lah. So I won't discount that. I won't buy IPO in the future. It's not that. It's just that how do I say that? Between the two, I still prefer the one that is in existence.
All right. That's
Mhm.
your preference. Okay. Now let's
Okay.
do one last question by Mina.
Uh-huh.
Stock prices fluctuate throughout the year. So which point in time should we use to get the stock price to determine the P ratio and the dividend yield?
If you want the current, then take the current lah. Okay, that's number one. Number two, if you want to actually do the past historical ratio, right? Some people want to be super accurate with things, right? Then they try to get the average price for that year and then divide by the earnings per share for that year in order to get the average PE ratio. Actually, you don't really, for me, right, I didn't really uh do that lah. I just take the closing stock price or somewhere closest to the closing stock price of that year. Take that figure, divide by its earnings per share for that year, do that for the past 10 years, and from there I have a rough guide already. So let's say the average, right? Let's say I do that. Of course, it's not super accurate, but let's assume that the average is about 18. And if you spend another, let's say 3 hours trying to be super accurate, at the end of the day, you get a PE ratio average of, let's say, 17.55 lah. To me, that 3 hours is not so well spent already lah. Because what is the difference between 17.55 and 18? All right. So which means to say when it comes to valuation, I just do the rough work. But as long as the company is fundamentally solid, it's right, it's good, then good lah. All right. The valuation I can be a little bit off, just have some margin of error, and I'll still do okay one. Which means to say no need to be too particular lah. All right. No need to be too particular about the decimals when it comes to investing.
Yeah. So don't have to be precisely correct. Just have to be, more or less there. Okay.
Like property, just short story lah. Some people, okay lah, you want to buy a piece of property. All right, the price, let's say the price, you already know that, okay lah, 500,000 for 500,000, let's say the price. Or let's say the value of the property is 500,000 and the seller is offering you at 420, let's say at 420. All right. You know it's a good price already, but you somehow you want it to be 415. And then you piss off the seller. The seller say, I don't want to sell to you already. All because of the 5,000 ringgit. You blew up that deal. Then what's the point, right? So no need to be too. But then if let's say you're lead into real estate investing, what is the value of that 5,000? You could have factored in into a 30-year loan or 35-year loan, and it's like nothing. But you lose that chance already. So the moral of the story is that small little thing, right? Don't major on it lah.
All right. So that's all the time we have for the question and answer sessions with Ian Tai. So thank you so much, Ian, for sharing with us what are value traps and how do we avoid them. All right. So we have learned 4 types of value traps today and how do we avoid them. So ladies and gentlemen, you just heard from the co-founder of DividendVault, Mr. Ian Tai. Thank you so much, Ian.
All right. Thank you so much, Shane. Thank you so much, and thank you so much, guys, for staying with me.